Reserve Bank has raised the official cash rate to 3% as widely expected, the highest level in 7 years. With us is CTU economist Craig Rennie. Craig, it was a hawkish statement with some upside risk.
It certainly was. As you said, the bank increased the OCR up to 3%, up 50 basis points. And the language used by the committee was very strong. The Monetary Policy Committee was described as being resolute in its commitment to ensure consumer price inflation returns to within the 1 to 3% target range. And it committed the bank to further interest rate increases in the future. So definitely very strong language from the bank today.
So rate hikes into 2023, is that right?
Yeah, and certainly we saw across the forecast track for the OCR, that was higher in every period across the forecast period. Not by much, but by enough to suggest that it still doesn't think it's on top of inflation right now.
Do they need to be this tough?
It's a great question. And one of the key things is we actually don't know to what extent the interest rates changes are actually really tackling inflation, which is driven by external factors. So it's the extent to which the use of the OCR is either going to just turn the economy down as a means of reducing inflation, or whether or not it's going to do some long-term damage. And right now, we don't know.
In the news conference this afternoon, Adrian Orr said that he was confident that inflation would start to come down from now on.
Certainly, they forecast inflation to fall consistently, quarter after quarter after quarter across the forecast period, and it's forecast to reach 2% by March 2025. But the interesting thing there is that the track to get there is much higher across the period. So, for example, in the May MPS statement, December 2023 was due to see 2.6% inflation. It's now forecast to be 3.8% inflation. So that tracks much higher across the period, which again suggests that there's plenty more OCR increases in the pipeline.
Would there be room for increases above 4%?
Well, the track has the forecast track for the OCR has it approximately at 4.1% in the period, which is a really unhelpful number, but basically means just above 4% at some point in time at its peak. So it's likely that we're likely to see it get just above 4%, 4.25%. Some analysts have it at 4.5% peak. That's not in the forecast period, but it might well get there.
Is the Reserve Bank on top of inflation?
The Reserve Bank is on top of inflation in that it's on top of the what it can control. It's on top of how it's going to use the OCR to tackle inflation. Whether or not inflation continues to rise will be a function of many factors, including overseas factors, including wage factors. And so right now it's a guessing game. It's economics. We're forecasting the future. But it's a function of lots of things that it's not in control of. And that's where the key challenge is going to lie.
A lot of economic indicators would suggest that the global economic situation is slowing.
And certainly the RBNZ forecast lower GDP growth in the future for New Zealand. And the governor said today that this is being driven by subdued consumer spending in future, clearly as part of driven by the higher interest rate positions in future. But it's important to note that the Reserve Bank's not currently forecasting a recession or a decline in growth. Lower domestic economic activity in New Zealand over the short run is being offset by higher tourism and higher overseas incomes coming into New Zealand. So we really need to see that overseas tourism market come back in strongly if we're not to see the slowdown in domestic activity leading to a recession.
Did anything surprise you in what they said today?
Well, I certainly felt that the Reserve Bank talks about that maximum sustainable employment having long since been reached. And talk about employment's well above its maximum sustainable level. Unemployment certainly lowered 3.3%, but there's 190,000 people still in New Zealand who want more work and can't get it. So we're not yet at full employment, and unemployment's forecast only to rise to 5% by the very end of the forecast period. And we're trying to match up that slowing economy, slowing growth, and unemployment not rising as quickly in that period. And there's something in that story which I think we needs investigating a little bit further. The other thing I would say is that for low and middle income earners in New Zealand, the track dictates more pain in the future, and it's the extent to which that track is then going to actually reduce inflation much more quickly potentially than the Reserve Bank is actually forecasting right now. And so, the Reserve Bank's trying to walk a very tight line, but the risks on either side are quite high.
Craig Rennie, thanks for joining us.